Good morning, student. Now, today we are going to do the fixed and working capital. This is the part fourth of your financial management chapter. So, let us go through the meaning of fixed capital first. So, fixed capital involves the allocation of firm's capital to long-term assets or projects. So, managing fixed capital is related to the investment decision and it is also called as capital budgeting. So, the capital budgeting decision affects the growth and profitability of the company. So what does it mean? See, fixed capital is that part of investment which is used in purchasing of plants, building, machinery, all the fixed assets. So basically, this is called as fixed capital. When we say capital budgeting, basically here we definitely talk about that machinery in which or that project in which we are going to invest, which can fetch us just quicker amount of money or cash flows in the future. So simply that means if you are making an investment of 10 crores of rupees and we are having two projects, suppose you are having two machinery to invest on, and suppose you go for machinery A instead of machinery B, because machinery A can fetch your 10 crore of investment in a span of 5 years. On the other hand, the other machinery it will take around 10 years to fetch your 10 crore rupees. So definitely a machinery A you are going to invest on. So in this capital budgeting, we are going to assess the cash flow and whichever is the profitable project for us, we are going to invest our money into that project. Okay, so the long-term assets brings benefit over a long period and investment in the assets involves huge amount of funds. So whenever you're going to invest your money, it is going to be like it your huge amount of fund will be invested in the company. Now the capital budgeting decisions include purchase of land, building, plant and machinery as I told you. Then change of technology, expenditure of advertisement campaign, research, development, etc. So all the other related expenditure relating to it. Now factor affecting the requirement of fixed capital. So what are the factor which are basically which are going to affect your this fixed capital? Basically, it is the nature of the business. So what is the nature? See, the type of the company A is involved in the first factor which helps in deciding the requirement of the fixed capital. So a manufacturer company needs more fixed capital. Okay. On the other side, suppose it's a kind of other kind of company. Suppose it is a IT company, then there will be no or very less requirement of fixed capital because in IT firm definitely the computers will be used which are of less cost in comparison to the machinery. So basically it depends whether your company is a manufacturing firm or any other trading company or IT company like that. So it is the nature. It depends like fixed capital depends on that. Now what is the scale of operation? So the company which are operating at high scale means the company which are doing business at a very large scale of production, they will require more fixed capital means more machinery will be required as they need more machinery and other assets, whereas small scale enterprises need less amount of fixed capital. So it depends on the size or the scales of operation. Like if a company is producing too much of goods, then definitely they will require more machinery. On the other hand, if the company is small, then they are going to need less machinery, which means less fixed capital is required. Then the technique of production. If the company uses capital intensive technique, which means involvement of more machines in comparison to the labors. So in such a company, the fixed capital will be requirement will be high. And other side, if the company is a is using labor intensive technique, then they require less capital. Okay, so technique of production is also there, whether they are going for a capital intensive or labor intensive technique. Okay, now after this, technology upgradation. What is technology upgradation? So industries in which technology upgradation is fast and need more amount of fixed capital, as when new technology is invented, old machine become obsolete and they need to be buy new plants and machinery, whereas the company where technology upgradation is slow, they require less capital. So the definitely the companies which try to upgrade their machinery, definitely they will have to use more or invest more in fixed capital. So all the money which will go into the upgradation will be a huge cost for them. On the other side, the company who's doing very slow upgradation of their machinery, they will require less capital. Then growth prospect. So the company which is looking in the future for some growth, maybe they are trying to open more branches of their company, or maybe they will be coming out with more products, or a number of diversified products, like variety of product we can come into the market. So such a company, so company which expanding have higher growth plans require more fixed capital. The company which will see growth like this, they will require more fixed capital. And on the other hand, if the company is not looking for growth, then they will require less working capital, sorry, not working capital, fixed capital. Now diversification. What is diversification? If the company which have plans to diversify their activity by including more range of products, require more fixed capital to produce more products, as they require more plants and machinery, which means more fixed capital. So if the company is trying to come up with a new range of products, then definitely more machinery will be required, which means more fixed capital is required. If they are not planning to do or diversify their business or products, then definitely they will require less fixed capital. The second point is availability of finance and leasing facility. So if the finance is available very easily, like anytime you can get the money or leasing from all these kind of entities which provide you such kind of services, like bank provide finance, and so there are some leasing company from which you can arrange the machinery and all. So the company can arrange financial and leasing facility easily, then definitely they require less fixed capital. Then what is the need of doing all this fixed kind of investment when you can easily lease that machinery, or you can take any machinery for a long time period as a rent, as on rent. Okay, so basically leasing is a kind of facility wherein you can pay a lump sum amount and you can take leasing facility of a machine. It is just like a renting out a machine, and you can use that machine for a very long time period. So if easy options are available like that, so less money will be invested in fixed capital like machinery and all. Plants, machinery, amount will be invested less. Now, if on the other side, financial and leasing facilities are not there, easily or not getting, then you will have to use more fixed capital. Okay, in that case, more capital is required. Now, level of collaboration or joint venture. So when two companies are joining hands together to do a certain business, it is called as collaboration. Okay, like if company are preferring collaboration joint venture, then company will need less fixed capital. So if in case study it comes that the two companies are joining hands, okay, in that case what happens, both the companies capital will be added. So in this case all this money of both the companies will be added together because they are going to do business together. So this will increase their amount of cash availability with them, so that in this case they will be requiring less fixed capital, because easily the capital will be available when two business houses join hands together. So what they can do in this case, the less fixed capital is required, then they can share the plant and machinery with their collaborators. But if the company prefers to operate as independent units, suppose if the company don't want to join hand with the other company and just want to do business separately, then in this case what will happen, they will have to go for this fixed capital, more fixed capital will be required. Okay, now after this, the another thing is working capital. This is your new topic now. So what is working capital? It is nothing but the excess of current assets over current liabilities. So what are current asset? Stocks, debtor, cash. On the other side, what are current liability? Like creditors, bills, payables. So what happens in the business? Simply see, whatever amount which you can generate through the help of sales of stock, like all this stock, debtor, cash. Debtor are the peoples from whom you have to take money because you have sold to them. Okay, so actually they will be giving you money because they have purchased something from you. So you will take that money of all these current assets, and you will be using that money for paying your current liabilities. If this rotation of money is good, then you'll have to use less working capital. What is working capital? Day to day transaction activities of the business require some cash, so that cash availability is called as working capital. by which you operate your day-to-day expenses of your company. So here it is just like current assets over current liabilities, means you can manage your current liabilities with your current assets. Okay, in case you cannot get the money from the debtors, then it will be difficult to pay your creditors and all. So what you'll have to do, from where to get money? Then again you'll require some working capital. Maybe you'll take the short term loan from the bank to pay this current liabilities. So here what are the meanings of this? Let us go through it. So first is gross working capital. So here the gross working capital means this refers to the investment in all the current assets such as cash, bill receivables, prepaid expenses, inventories, etc. So whatever the bills receivable you will be getting from all this data, you will ask money from them because they have purchased something from you. Prepaid expenses, all the expenses which you are paying early before taking any kind of service, it is called as prepaid expenses. It is also treated as asset, current asset. Okay, now inventories are nothing but your stocks which you maintain. So all these things, investment in such kind of things, it is called as gross working capital. So these current assets get converted into cash within an accounting year. So basically within 1 year we expect that all this should be converted into cash so that we can meet our or pay our current liability easily. Now what are the examples of current assets? Like in accounting you already must have gone through it. It is cash, debtor, stocks, marketable securities which you can sell and get money, finished goods inventory, like this is your stock, bills receivable means you'll be getting money from to whom you have sold the goods. The work in progress, so it is work in progress means manufacturing is going on. So this whatever the manufacturing, the amount which is going on in the company, the product which is under manufacturing in process, it is called as work in progress, which is not converted into finished good yet. Next is raw material. Okay, then prepaid expenses. So all these are your current assets. Now second is net working capital. So this refers to the excess of the current assets over current liabilities. First of all, now current liabilities are to be paid within an accounting year. Okay, so here basically whatever the current asset you are having above your current liability, suppose your current assets are 10 lakh rupees and your liabilities are of 20 lakh. Are you in able condition to pay this 20 lakh with your 10 lakh rupees from this current assets? Certainly, this current assets are less and liabilities are more. This will be in minus 10, which means you will not be able to pay. So this shows the poor liquidity position of the company, means company is having very less cash position to pay its current liability. So basically net working capital is seen like this. Okay, so current liabilities are source of fund for acquiring current assets. Suppose the company gets credit for maintaining the stock, then the stock which is current asset gets created with the credit purchase which is current liability. So basically company, when company purchases any kind of stock on credit, so definitely they will have to pay to the creditors, means there is a liability. Whatever the goods the company is purchasing as a raw material maybe, so they will have to pay money to the creditors. And how they are going to pay? Basically they will have to convert their current assets into cash within a span of 1 year in order to pay the current liabilities. So by taking out all the money by this sales and or this arrangement, you can make good the payment of current liability. If you are unable to do, then it shows that your liquidity position is very poor. And the company who's getting this positive net working capital, like in this case suppose the net your current assets are 10 lakh 10 lakh and your current liabilities are just 5 lakhs, so this is plus 5, like plus 5 position. This shows the positive net working capital position, which is a sound position, so in which you can easily pay your current liabilities. Now what are the factors which affect the working capital? Again, it's the nature of the business. Okay, so basically in case of trading concern like IT company or retail shop, the requirement of working capital less because the length of operating cycle is small. So in the small company, what happen, your working capital requirement is less because the operating cycle means whatever the conversion of raw material is taking place into this finished goods is happening very quickly. So the operation cycle is very small. So because of that, they will require less capital. Okay. On the other hand, if the company is big, so the operation cycle will also be big. So in that case, what will happen? They will have to use more working capital. They require more working capital because their operation cycle will be long. So the wholesaler as compared to the retail shop require more working capital as they have to maintain large stock and generally sell goods on credit, so which increases the length of operating cycle. So same thing here, they have given the example of wholesalers. Now definitely wholesaler will require more capital because they will have to keep it all this goods for a long time, and also they will be working on credit. They are not like retailers basically who will be availed easy credit terms and all this, because they generally deals in cash and all, and they require some huge working capital. Now, scale of operation. Scale means large scale means more amount of production, low scale means less amount of production. So the firm operating at large scale need to maintain more inventory debtors. Okay, so company which is producing a lot, then they will have to maintain more inventories and more debtors will be there, so generally they require large working capital. So in this case they will be requiring more working capital, but the firm which operates at a small scale require less working capital. So in this case, the small company with a low scale of operation, they will be requiring less capital. Now business cycle fluctuations. So during boom period, the market flourishes, so the demand for more production, more stock, more debtors, which means more amount of working capital is required. So in the boom period, what will happen? There will be more data, more debtors, more stock will be required, more production will be done. So in this case, the working capital will be required. So you'll require more working capital in this case. But when the time will come, when the depression period will come, there will be low demand. So in this case, we will be we will be buying like less inventories or less raw material. So we will require less working capital here in depression period. So you remember this, in boom period, more working capital will be required, and in depression period, less working capital will be required. Okay. Now seasonal factor. What are seasonal factors? The capital requirement is constant for companies which selling goods throughout the season. Okay. So the working capital required constant because in every season they will be manufacturing. Like if you take example of a biscuit manufacturing company. So biscuit are manufactured throughout the year. So their capital requirement, working capital requirement will be constant. But if there is a company like a raincoat making company, or the company which will make some rainy season goods, maybe umbrellas or raincoats like that, so their working capital will increase in that particular season. Otherwise, it is not going to increase, and the rest of the days they will not require that much of working capital. Now, technology and production cycle. So, if a company using labor intensive technique, means more labor will be used instead of capital. तो लोगों को ज्यादा रख के काम करेंगे, कैपिटल यानी कि मशीनरी या कैपिटल इंसेंटिव टेक्निक मतलब ज्यादा मशीनरी रख के काम करना. So here with the if the company is using labor intensive technique of production, then more working capital is required because the company needs to maintain enough cash flows for making the payment to the labor. So here more money is required, working capital, because you will be making small payments in terms of wages to this labor. So labor intensive techniques attract more working capital. If your company is going through the capital intensive technique, okay, or machine intensive is written over here, or capital intensive, both are the one thing, okay, or production, then less working capital is required. So if machine is been operated, so there are less labor, so you'll be paying less amount of wages, so easily you can manage within less working capital also. Okay, now credit allowed and credit availed. So what is credit allowed? So credit policy refers to the average period of collection of sales proceed. It depends on the number of factors such as credit worthiness of the clients, okay, industry norms, etc. If the company is following a liberal credit policy, then it will require more working capital. Whereas if a company is following a strict or short-term credit policy, then it can manage a less working capital also. So if you're suppose you are company A and you're selling to some other company, so what happens here? Basically, you're allowing them the credit that you can tell them that you can give money easily after 2 months or 3 months. So 2 month time if you are giving to them, so this is the credit time period which is allowed, and you'll be getting money after 2 months. So this kind of policy is very liberal credit policy. So easily the client to whom you are selling your products, they will be having 2 months to pay your amount. Then what will happen? It will require more working capital, because if the company is following a strict or short term credit policy, then it can manage a less working capital also. मतलब यहाँ पे क्या लिखा हुआ है बेसिकली, अगर कंपनी कम टाइम पीरियड देती है, सिंपल सी बात है, मैं कंपनी को बोलता हूँ, मैं जिसको बेच रहा हूँ गुड्स, मैं उसको बोल रहा हूँ कि सिर्फ मैं आपको 15 डेज का ही टाइम देता हूँ, मेरा पैसा मुझे वापस दे देना, इससे ज्यादा हम नहीं रुकेंगे। जो भी मैं क्रेडिट पे सेल कर रहा हूँ, 15 डेज क्रेडिट। और एक तरफ हम क्या बात करें, वी आर टॉकिंग अबाउट 2 मंथ्स। तो दोनों में फर्क है, एक में 2 महीने बाद पैसा मिलेगा और एक में 15 दिन में ही मिल जाएगा। तो 15 दिन में ही मिल जाएगा तो वर्किंग कैपिटल कम चाहिए रहेगा, और जहाँ पर आपको ज्यादा टाइम लगता है, बेसिकली ज्यादा टाइम लगता है पैसा मिलने में, वहां पे वर्किंग कैपिटल फिर आपको चाहिए रहेगा, क्योंकि पैसा नहीं आएगा। तो ये पॉइंट बहुत इंपॉर्टेंट है, इसका ध्यान रखना, क्रेडिट आप कितना अलाउ कर रहे हो। देन क्रेडिट अवेल, ये तो क्रेडिट अलाउड मतलब आपने दूसरी कंपनी को कितना उधार में बेचा और कितना टाइम बाद वो देगा। क्रेडिट अवेल का मतलब यहाँ पर ये है बेसिकली, विन विच यू आर बीइंग गिवन क्रेडिट। ओके, आपको क्रेडिट दिया गया है किसी और फर्म के थ्रू, कौन देगा? मे बी आपके क्रेडिटर देंगे जिनसे आपने परचेस किया है, और उन्होंने आपको बोल रखा है कि आपको 20 दिन का टाइम देते हैं हम, या फिर वो बोलते हैं कि हम आपको 2 महीने का टाइम देते हैं, तो डिपेंड्स ऑन द टाइम। Okay, so another factor related to the credit policy, how much and for how long period company is getting credit from its suppliers. If the supplier and a creditor, okay, if suppliers of raw material are giving long term credit, then the company can manage विथ लेस अमाउंट। तो अगर आपको लॉन्ग टर्म क्रेडिट मिल रहा है तो कंपनी आराम से मैनेज कर सकती है कम वर्किंग कैपिटल में। इफ द टाइम पीरियड, अगर आपको टाइम पीरियड बहुत कम दिया गया, तो उस केस में क्या होगा बेसिकली, अगर कम टाइम पीरियड दिया गया तो आपको जल्दी जल्दी पैसा लाना पड़ेगा, मतलब ज्यादा वर्किंग कैपिटल की रिक्वायरमेंट पड़ेगी। सो वेर एज इफ द सप्लायर गिविंग ओनली शॉर्ट पीरियड, देन कंपनी विल रिक्वायर मोर वर्किंग कैपिटल। नाउ ऑपरेशन एफिशिएंसी, if the firm are having high degree of operating efficiency, requires less amount of working capital as compared to the firm having low degree of efficiency, which requires more working capital. So if the operations of the company means production if is going on at a very good speed or pace, then quickly what happens, see what is operating efficiency, when your goods are being manufactured and sold in the market and quickly the money comes to you, so this entire thing is operating cycle. Okay, and if the money is coming to you very quickly in a short span of time, then you'll require less working capital. But if this operational efficiency is less, means it is taking a lot of time to manufacture the goods, then in sales also it is taking a lot of time, then the money is coming to you, so long time period you'll have to wait for your money, or you can say a long time period it will take for your products to get sold in the market, and then only the money will come to you. So this operational efficiency is very poor, so in this case you will be requiring more working capital. Now 9 point is availability of raw material. So here, if the raw materials are easily available, then there is ready supply of raw material and inputs. So this firm can manage with less amount of working capital. So if the raw material is available very easily, then less working capital is required. Okay, and there is no need to maintain the stock of the raw material also, because they are easily available. They can manage with very less stock also. Now, whereas if the supply of raw material is not smooth, if you're not getting this raw material easily, then you'll have to purchase and maintain high or large inventories or raw materials to carry on your business or operating cycle smoothly. So you'll require more working capital, यहाँ पे पैसा ज़्यादा चाहिए रहेगा. Okay, now level of competition. See, if in the market is competitive, there are a lot of competitor of your company, then we will have to adopt a liberal credit policy and to supply good on time. Higher inventories have to be maintained, so more working capital is required. So if the level of competition is high, then what will happen? You'll have to wait, or you'll have to give more credit to your creditors. In this case, what will happen? You will be maintaining higher inventories. So when you maintain higher inventories, so more working capital will be required. But if a business with less competition, suppose competition is very less, in this case, what will happen? Your requirement of working capital will be low because you will be having a monopoly position in the market. So in such a case, your working capital requirement will be less. What will be the case of inflation? If there is increase or rise in the price, then the price of raw material and the cost of the labor will rise. It will result in an increase in the working capital requirement. So what happen in the market, if the prices of raw material and the labor is rising, then definitely more money will be required to make the payments to this labor for this raw material. So here the working capital requirement will be high. But in the cases when inflation is not there, but if the company is able to increase the price of their own good as well, if there will be less problem of working capital, the effect of rise in price on working capital will be different for different businesses, for different businessmen. So basically here, if you can manage, like if you can raise the price of your products or goods also, then definitely you, when this product will be sold in the market, your money will come to your company and you can easily manage even in the tight situation of inflation. तो महंगाई की situation भी हम आराम से, अगर पैसा प्राइस बढ़ा सकते हैं, तो उसको हम मैनेज कर सकते हैं, इन्फ्लेशन को, महंगाई को. इट विल नॉट बी अ प्रॉब्लम, इवन इन लेस वर्किंग कैपिटल वी कैन मैनेज. नाउ द ग्रोथ प्रोस्पेक्ट. So if the firm is planning to expand their activities, will require more working capital. Okay, so same point is there, like in fixed capital it was there. So if you are planning for expansion, कंपनी कोशिश करेगी कि हमें और एक्सपेंड करूंगी और ब्रांचेस करूंगी, सो वहां पर क्या होगा, दे रिक्वायर मोर वर्किंग कैपिटल. एज फॉर एक्सपेंशन, दे नीड टू इंक्रीज द स्केल ऑफ प्रोडक्शन, क्योंकि जब एक्सपेंशन की बात करेंगे तो स्केल ऑफ प्रोडक्शन यानी कि प्रोडक्शन लेवल को बढ़ाने की बात करेंगे, विच मीन्स मोर रॉ मटेरियल एंड मोर इनपुट्स विल बी रिक्वायर्ड. When these more inputs and more requirement will be raw material will be there, definitely more working capital will also be required. So depends, कंपनी प्लान कर रही है कि ग्रोथ करने की तो ज़्यादा पैसा लगेगा इन चीज़ों में, अगर नहीं कर रही तो कम लगेगा. द थिंग इज दैट. Okay, so this was your last part, fourth, of a financial management chapter. After this we are going to do the next chapter. If you're having any kind of doubt in this chapter, you can ask me on WhatsApp. Thank you.